Hello and welcome back, guys. So, in this particular session, what we will be discussing about is Zippy. Okay, so Zippy is a parent company, and then it owns Guinea, and then after that, so it's basically from SPR's exam kit. Okay, so what we are given in the question is that Zippy is a manufacturing company with a reporting date at 30 June 20x6. It has a wide portfolio of investment properties as well as investment in many other entities. The draft statement of profit or loss and other comprehensive income for those entities. Gini is provided below. Alright, so revenue is 132, cost of sales is 176, gross profit is 56, investment income is 19, administrative cost is 12, other cost is 18, right? Sorry. And then what else do we have? Finance cost is 6 million, tax expense 7, right? Required is explain with suitable calculations how investment in Gini should be accounted for the consolidated statements of profit or loss and OCI for OCI of GP Group for the year ended 30 June 20x6. Is there a OCI as well? Okay, so let's read this first of all. OCI is there, gains on property revaluation, right? So which property has been revalued? We will need to look at that as well. Okay, so on 1st July 20x4, so that means how many years ago? So 30 June 20x6 is our reporting date, right? So that means it was purchased 2 years ago. So acquired 60% of the equity interest of Genie, a public limited company. The purchase consideration comprised cash of 90 million and a fair value of the net identifiable net assets was 114 million at the date, right? GP uses full goodwill method for all acquisitions, and the fair value of the non-controlling interest was 50 million on 1st July 20x6. So same date. Goodwill had been reviewed annually for impairment, and no impairment was deemed necessary. Okay, no impairment, easy then. So GP disposed of 20% equity interest in Genie on 31st March 20x6. So what's our reporting date? Let's check that again, whether it's a mid-year or not. So 30 June 20x6. Yes, it's a mid-year. So that means 31st March, right? So March is gone. April, May, June. That means 3 months is only remaining. That means the company is or we need to prepare a consolidated for 9 months, right? Because 3 months, after 3 months it's already disposed, so it's only significant influence. So what do we need for significant influence? Control. When do we lose our control? Is that what is the definition of control? So it's basically when the investor has power over the investee, the investor is exposed or has a right to variable returns from the investee, and then after that the investor is likely to use its power to affect those variable returns, right? So other things that we need to also discuss about is the criteria. So what are the criteria of being when there is a control, right? So how do you determine that? So when there are numerically large dispersed group of investors, that will also determine that even though you might have a less than 50% holding, but still you might have a control over that entity, right? So it might happen in that criteria, or it might happen in the agreement between investors, whether it will be a unanimous decisions or it will be based upon the holding percentage or something else. So it might depend on that as well. And then the representation on board as well. Okay, so whether, even though if the holding is only 40%, but the board BOD representation is 60%, so that might mean that the company has control over it. Okay, so it's always what we need to figure out is that not legal form in this thing as well, because in legally you might see like, okay, it does not have any control, but economic substance might have control. Okay, So we need to look for that. Okay, having said that, so now we need to determine whether the control has really been lost or not, right? So it does not talk about BOD and anything else. So on disposal date, the remaining 40% had a fair value of 62 million. GP was left with significant influence. So the question clearly says it. Significant influence, right? Zippy accounts for investment in subsidiaries at cost and has included a gain in investment income of 14 million. So Zippy accounts for investment subsidiaries at cost and okay, so that has so what it normally does is that it accounts for it in cost, right? And has included a gain in investment income of 14 million within its individual financial statements to reflect the disposal. The net assets of Genie had a fair value of 118 million at 1st July. Okay, don't get confused in that. We need to add profit as well in this particular figure because that's the profit until previous year, right? So this was reflected in the carrying amount of the net assets. All gains and losses have been accrued throughout evenly throughout the year. The disposal is not classified as a major separate line of business or geographical operations. That means it is not classified as discontinued operation. Okay, so what is discontinued operation? Anything which has been sold or has been classified as held for sale, right? What are the criteria? The criteria being that it should be a separate major line of business, and then the second criteria being that it should be a single plan to dispose a separate line of business or non-core activities. Okay, so it should be a separate line of business, okay, or geographical area, okay. And then after that, if it is a subsidiary, purchase for resale, okay. So it does not meet that criteria, so no need to worry about that as well. So what do we do then? Let's calculate goodwill first of all. Note 1, group structure, parent, NCI. So 60 and 40, right? 60 and 40. And then after that, working to calculation of net assets of subsidiary. Okay, here will be an interesting thing that we need to remember. Reporting. So we only prepare it for the till the date of disposal, okay? So what was the net assets? At acquisition, the question clearly says that at acquisition the net assets had a fair value of 114, right? So fair value of 114, okay, 114, that's there. And then after that, at reporting date, how much is it? Or at disposal date, you can say that as well, okay. It is so had a fair value of net assets had a fair value of 118, right? So 118 plus, that's what's the profit for the year, 32 into 9 divided by 12, 142. Look at something else first of all. Let's prepare our goodwill first of all, and might have to make some adjustment in there as well. Calculation of goodwill, right? Bolded cost investment fair value of non-controlling interest, right? And then less net assets at acquisition at ACQ. So this figure is from here itself, and then after that our non-controlling interest is also already there, so it's 50, and then after that our cost is purchase consideration is 90, right? So 50 and 90, 50 and 90, 90. This plus this is equals to this plus this total goodwill, right? Bold it, okay? So our goodwill is 26, okay? So it has not been impaired, no need to worry about anything. So goodwill is out of the way now. So what has happened is that Zippy has disposed some of its holding, right? So for cash consideration of 44 million, right? That means on 31st March, right? And 31st March means 9 divided by 12. Okay. That's when it disposed of, right? So we know that I'm not going to write at reporting at disposal, okay? And then there is something else as well, I guess. There is OCI as well, gain on property revaluation, right? So what does it say over here is that SPI accounts for investment in subsidiaries at cost and has included a gain income of 14 million within its individual financial statement to reflect the disposal, right? So why did it do that? We will need to figure that out as well. So first of all, what we'll do is that 16 into 9 by 12. So 16 is basically for the whole year. So we need to plus 16 into 9 divided by 12, right? So that's our thingy. At disposal, it's profit, right? After that, what we need to find out is that working note 4. So what was the profit? Let's find out as well. And then we will start describing it, okay? So how much money did we get? Proceeds, and then after that fair value of retained interest. So how much proceed did we get? 44 million 62, right? 44 and 62, 44 plus 62. So this is the full value of the company, okay? That's what it's worth. What we need to deduct from it is interest disposed of, right? Disposed of. So in this case, there will be goodwill at disposal. Okay, at disposal. Always remember there is a difference between that as well. It's always good to write, not NCI. Goodwill at disposal and then net assets at disposal. And then after that we subtract less NCI. Okay, so we will need another working as well. Working with 5. Bold it because we need to find out the NCI percentage as well. Copy, paste, share of post acquisition profit, right? Post acquisition profit being, what I'll do is I'll just copy this figure into this figure. Okay, so let's say this is post acquisition, this minus this, right? And then total being this plus this. So 66 will be our NCI at disposal, right? At disposal. 66, and then after that net assets at disposal is 154, right? And then our goodwill at disposal is, since it has not been impaired, so it's the same figure. So what we need to do is that this will be subtracted from this figure. Let's move it to the side, and then a subtotal of this plus this plus this, so 114, right? So there has been a loss. Interesting. Loss on disposal. Okay. So first of all, what do we do? So the Zini, that's the name of the company. So let's explain for the first 9 months first of all. Bold, underline. During the year, Zippy had control over Guinea for only 9 months. So consolidated SOPL needs to be or the statement for 9 months should be consolidated, right? 9 months should be consolidated. on a line by line basis. Okay, let's write that as well. Line by line basis. So during the year, Zini made a profit of. So once that's done, let's find out how much is the profit. Okay. So profit, 32, right? 32 into 9 by 12. 32